Gold Trading Strategy 1. Open one buy and one sell position daily at the time of the market open, and set a take profit of $3 for both positions. Based on my 10 years of historical data analysis of the gold daily candlestick chart, there is an 80% success rate of hitting both take profits. Here are some frequently asked questions that will help you better understand this gold trading strategy. Question 1. If one of the positions does not close, what should be the next step? Should we place a stop loss in that situation? The answer of this question is, there are up to 20 to 25% chance that one of the positions may not close on the same day. I can explain how to manage these open positions using a strategy flowchart. Before studying the flowchart, let me tell you that your trading journey becomes easier with the right coach beside you. So keep me in mind while trading this strategy. Thank you. Place your positions at the Sydney session opening time. That means 2 a.m. in UAE, 3 a.m. in Pakistan, and 3:30 a.m. in India. Just follow your own country's market opening time. Step 1. I am doing the calculation with 0.01 Oz and taking $40.12 as the reference price. So open one buy and one sell position at $40.12 and set the take profit at $40.15 for the buy and $4,009 for the sell position. Now watch and check whether both of your positions have closed. That's it, the strategy is complete and you earned a total profit of $6. The market moved up to 40.15s and hit your buy position take profit for $3 and then moved down to 4,009 and hit your sell position take profit for another $3. Based on 10 years of historical data, 80% of positions close on first step. Now we discuss the 20% case where one position closes and the other stays floating. Consider this scenario. The market goes up, hits the 40.15 TP of the buy, and the sell position stays open. Now wait for the market to move $30 up to 40.42s, and if it does, then continue with the next step 2. Step 2. Open one more buy at $40.42 with no take profit, and open one sell at $40.42 with a $15 take profit at $40.27. At this stage, you also need to edit the take profit of the previous sell position to $40.27. Now there are two scenarios. Scenario A, the market goes down, and Scenario B, the market continues moving upward. First, we discuss Scenario A, in which the market goes down to $4,027 and hits both sell take profits, one closing with a $15 profit and the other with a $15 loss. At this stage, we now have only one buy position open, showing a $15 floating loss at the market price of $4,027. Here again, there are two scenarios. Scenario C, where the market goes up, and Scenario D, where the market goes down. In Scenario C, the market goes up and hits the take profit of the new buy position. Step 2 is now complete, and you earned a total of $6. How? Your first buy position closed at 40.15s with a $3 profit. Both sell positions closed at 40.27 with no profit and no loss. And finally, your new buy position closed at 40.45 with another $3 profit. Your net profit will be $6. There is only about a 20% chance that you will need to follow the Step 2 process, and in 80% of cases, the strategy completes in Step 1. Now we discuss Scenario D, where the market continues moving down instead of going up and hits our new buy position that we discussed earlier. In this scenario, if the market falls further to 40.12, we simply repeat Step 2 again using the same rules. Do you remember Scenario B, where we opened two new positions at 40.42? In this scenario, the market continues moving upward instead of going down and reaches $40.72. In that case, you need to follow Step 2 again by opening a third buy and a third sell position and continue applying the same Step 2 rules. This completes the process of managing positions when a trade doesn't close on the same day. It's not complicated. It simply requires the right guidance. My coaching services are always available.